Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and we had some major data out in Australia today. Wages growth, the highest in a decade. But first, I just want to touch base with you on US existing home sales. Now, those of you who follow my column or these videos will remember that, June, July, August of 21, I started saying that the United States was already in the process of creation, or well, actually nearing the top of its second great property bubble of this century. That's how roller coaster the US economy has been, in that it can have two property bubbles already, and we're at year 23. So that bubble is already bursting. And we've certainly seen that as property prices begin to fall increasingly around the United States, and as an average on the United States are already declining. And existing home sales yesterday in the US, again, another fall. The pattern of the existing home sales looks almost identical to that of the GFC. And in fact, existing home sales are already at GFC levels. So that gives you an idea of the hidden crisis that lay within some of the glossier numbers that some people want to point to about the US economy. It has a very dysfunctional aspect at the moment in many regards. So US economy does not look good. And if you have the Fed continuing to hike aggressively, as I believe they are going to, by not just 50 points, but 100, 150, or even 200 points more, then that housing property bubble is going to continue to unwind, if not burst spectacularly. Probably just a steady, long, drawn-out unwinding, as is going to be the realignment of the US economy, which is going to take 1, 2, or 3 years. It's not going to be over this year, as some of the fairy tale economists and pundits had you believing. So that's what's happening in the US. Further data continuing to show that the US economy is facing a bigger crisis than a lot of people want to let on. I've probably been the only economist that's highlighted that property bubble from so early on, and that's because a lot of other people probably saw it but didn't want to report it. But it is very real and it is there. Coming to Australia now, we had, as I said, the highest wages growth in a decade. Now, for some reason, the stock market thought, oh, that's good news, we'll rally. What it means is that the Reserve Bank of Australia will be raising interest rates as far as you can see to the horizon and beyond. There is no end in sight to RBA rate hikes because a wages prices spiral is the scariest thing on the planet, or in fact, in the universe, for a central banker. And that's exactly what we are seeing clear signs of now. In terms of economic performance, this is all bad news, because it means that wages are declining in real terms, adjusted for inflation, by around 4% per annum at this point. This is why you have organizations like Coles reporting that shoppers are changing their purchasing patterns. They're stopping buying steaks, they're buying mints, they're stopping buying the expensive brands, and they're buying the home brands. So there is real pressure out there in our society that will come through and impact the economy overall. At the moment, we have a two-speed economy. It's about the upper middle class and the wealthy continuing to spend as if nothing's wrong, wanting to look the other way, a lot like some of the American economists on the American property market. And you have the majority of the Australian population really already really hurting from superinflation that was allowed and generated. In fact, it wasn't just allowed, it was generated by the Reserve Bank keeping interest rates near zero and its quantitative easing policies. So it was generated and allowed to run away. Inflation was generated and allowed to run away by the Reserve Bank. That's its real failing, not that it's hiking now. Hiking now is, as I said, over a year ago would be their second big mistake. I said their first big mistake was to not understand that inflation was going to be hitting our shores and that they needed to be raising interest rates gently a year ago. If they didn't do that, they would make the second big mistake of hiking rates too aggressively, too late in the piece to chase inflation that's already well and truly got away from them. So the RBA is making that mistake, but you can observe the RBA for what's actually happening, but then you have to adjust. When we're going to give you an interest rate outlook, it has to be based on what we think the Reserve Bank will actually do. So what they should do and what they do is often very different. In fact, I've always said for over a decade now, they are two entirely different things. So what they should be doing now is pausing rate hikes, because really they're not going to stop inflation with further interest rate hikes. They're just going to hurt the consumer, which was the point I was trying to make, is that consumers are being squeezed by higher borrowing costs, mortgage stress that's going to be leaping ever higher, and the higher price structure that they're dealing with already. Very difficult environment as their wages, and therefore, as a result of the inflation, their real wages are falling about 4% per annum, the Australian workplace. This is not good for the Australian economy. So there are dark clouds still surrounding us. They're not on the horizon. We're living in them. And there is no light at the end of the tunnel as yet. Perhaps there's a misty glow somewhere, but there's no identifiable way out of this as yet. So there's going to be further downside for the Australian economy. Not sure why markets were so excited about that wages growth number. Perhaps they just thought, oh, that's great, the consumer's okay. No, the consumer is not okay. They're actually 4% poorer over the year. And that's going to persist for some time. And the RBA is going to make their pain even worse, which is why the rally in the Aussie 200, rally in Australian shares generally, could be an opportunity to again, apply some protective defense hedging strategies for your investment portfolios. Certainly playing defense still seems to be wise. The US stock market falling as I've told you it would, absolutely getting that right. Could have a little bit of a bounce today, but making a new low again would just be a fresh sell signal from a short-term perspective. From a medium and long-term perspective, you should really be, as I've been saying since the first week of January 2022, you should be hedging, playing defense. Hedging, playing defense. Hedging, playing defense. Haven't changed that tune. The markets are still bearish since then, still lower, still looking like they could have another fresh run to the downside. So it's not a rosy outlook for equities. Now, on the currency front, there could be a twist about to happen. As you know, I have been bearish the Australian dollar since 0.7745, 77.45 cents, when I went on national TV and said the Australian dollar was going to 70 cents. At that time, most of the other people around the marketplace were saying, no, the Aussie is going to 80, 82, 85 cents. And I said, no, it's going to crash to 70 cents. Around 74, I said it's going to crash 65, maybe 58. Not bad forecasting. I still was medium-term bearish. I'm starting to think, I haven't quite pushed the button, but I'm starting to think it is possible that we may be entering a phase, nothing great happening about Australia, but we may be entering a phase where not only do you sell US stocks, because obviously US equities are in decline after a good start to the year, they're now in decline. US property prices are in decline, bonds are in decline, the US has massive trade fiscal deficits, and is increasingly involved in a war, a significant war, and has an economy that's struggling. Therefore, I'm starting to move to the point where even though the Fed will be, and I'm the most hawkish Fed caller in the world and have been for some time and proven correct, even though the Fed will be raising interest rates, it might almost be that tipping point now that I mentioned a couple of months ago. At some tipping point, it's going to be a time to sell the US dollar, even if the Fed is hiking rates. We could be approaching that point, in which case the Australian dollar could turn into a buy on a medium-term basis in the next few days to a week. So keep an eye on the price action at the moment. If we make a new low in the Australian dollar, don't be slow to sell. As I said, I'm just having a moment of hesitation here. We'll see what happens. but I do think we need to be mindful of that risk scenario that not only selling US stocks, but maybe selling the US dollar as well, could be an interesting path to pursue going forward. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities. Have a wonderful day.